Welcome to the CFO and Finance Leaders series brought to you by Fortinus Events. I'm Faida Maria Abbas, and today we are exploring one of the hottest finance topics in the GCC, tax transformation. If you're a CFO or a finance leader, you know that tax is no longer just about compliance. It's about strategy, technology, and so much more. Joining us today is Hany Elnaggar, partner and tax and compliance leader for the Middle East and GCC at Acquisory Advisors, a silver sponsor. With over 20 years of tax experience, he has held senior tax roles at Novartis Pharma, Nissan, Tayer Group, Ericsson, PwC, and ACWA Power International, as well as tax partner in WTS Dhruva Consultants. He was nominated by ITR International Tax Review for In-House Tax Director of the Year for 2022 and Tax Author in IBFD. Hany, welcome to the show.
Thank you, Farid. I'm very excited to be with you today. Thank you.
Okay, let's begin. So the UAE introduced corporate tax a couple of years back. Saudi's been doing this longer. Where are we now? Because we hear CFOs say they are still figuring out the basics.
Yeah, Farid, you are right. So even so, the UAE implemented corporate tax in 2023. Many CFOs are still on the initial stage. Saudi Arabia, of course, has had the tax rules for decades, so businesses there are more mature in their processes. In the UAE, companies understand the law now, but the challenge is implementation, documentation, transfer pricing, substance requirement, system readiness, and aligning accounting policies with tax reporting. So, where are we now? We are past the awareness phase, but we are still early in the execution and quality. Execution and quality phase. The basics are known now. So anyone in the market now knows the basics about corporate tax, especially. However, the integration into daily business operation is where most companies still struggle.
Okay.
Right.
And what is the biggest mistake you are seeing? Like, what are finance team getting wrong right now?
In my view, the biggest mistake is treating corporate tax as annual exercise instead of an operational one. So many teams still prepare tax return at year end without maintaining proper documentation throughout the year, especially for related party transactions, management fees, expenses deductibility. This is the biggest mistake. However, also another major mistake which I can also share, assuming we are a free zone means you are exempt. There is a concept with many CFOs or companies in Germany. This is wrong. This is a big mistake. Many free zone companies miss the conditions, especially the substance list, qualifying activity list, transparency documentation, and that would be very costly for us. Right.
Right. So, what should they be worried about next? What's coming in 2026 that most people aren't ready for?
2026 is the year of digital enforcement. So I can list down some points combined with you. What is coming is, as an example, full e-invoicing rollout is a data-driven audits. Pillar 2, very important, minimum tax filing for large groups. Uh, Much stricter substance and transfer pricing audits. This is, I can expect a heavy tax audit related to transfer pricing coming in 2026 especially. So most companies are not ready for the system side, ERP mapping, data accuracy, something like this. 2026 won't be about new rules. I expect swap calls, but it will be about strict enforcement of existing one, supported by technology, of course.
Okay. So let's talk about AI. Where is AI actually helping? What are you seeing at work?
Very, very interesting point. So AI is already transforming the heavy lifting because it can work based in automating reconciliation between accounting, VAT, CT, customs. It can also detecting errors in invoices, expenses, claims. It can also preparing tax competition and standard templates, analyzing contracts, real-time risk flags in ERP system. So in summary, AI removes the manual workload. So tax team can focus on judgment, planning, and strategic decisions.
Right. AI is being useful in all the industries like we see, and finance will have a major role as well from
Exactly.
AI. Yeah?
Exactly.
Right.
Exactly.
Yeah. Okay. So let's now talk about a little more about AI. A lot of CFOs think AI in tax is expensive or too early. What would you like to tell them?
I would say AI today is not a luxury, it's a cost center. If you can think about from this angle. So most solutions are modular and scalable. Companies don't need a big transformation project. They can start with small automations. Okay, that reduce hours of manual work. And please remember always, tax complexity is increasing, not decreasing. So if you don't invest now in AI, you will be more later in penalties, audits, overtime for the people, hiring people, resources, operational efficiency. So AI in tax is at the same stage I can see which cloud account was 10 years ago. So early adopts wait for the better function.
Right. Okay. What catches companies off guard when they implement e-invoicing?
About two or three things surprise them every time. It's not, first one, it's not an IT project. Let's agree with it. It's a business transformation. And second one, their data is not clean enough. So, like customer name, TRP numbers. Many companies discover in consultancy only when they try to integrate, not before. And every invoice must be validated in the server. So, and forces companies to change the internal workflows. Most of CFOs most of CEOs or financial manager or director underestimate the time needed for ARP integration, testing, and adapting internal approvals to reinvoice. Yeah.
Okay. So, what tax incentives are CFOs missing? What should they be asking their tax teams about?
So in all the years, tax incentive was very basic, very routine. Like you can, in some of the countries, you have 5 years tax incentive, 10 years tax incentive. But many CFOs don't realize that GCC has far more incentive today than before. The most overlooked are, from my view, I can list down maybe 4 or 5. So, based on 0% corporate tax. Yeah. Of course, again, but only if you meet all substance criteria and conditions. Saudi KSA, they have RGP incentive for the strategic cooperation, also again, with some conditions, some of the requirements. Pillar 2 reliefs, such as substance-based earnouts, uh, investment incentives in Oman and Bahrain, they have investment in soil. Research and development, which are R&D deductions and capital allowances that many companies never fully use. They should also use such incentive, tax grouping, loss transfer operation. So this can be considered. So CFOs should be asking. It's better to start this bit. How do we structure our operation to legally benefit from incentive without risking substance?
Okay. So, digging just a little deeper into this, what is the reason that CFOs are actually not utilizing the tax incentives completely? Like you said, many are getting left behind and all those
Yeah,
stuff. What is the reason? It is like lack of knowledge, or is it too complex to dive into, or is it very difficult, or what is it?
it's a mix. It's a mix. So lack of knowledge, one of them. Some of the incentive is not publicly published. So if they need someone who can dig more on the local regulation for each country, some practical experience with the local tax authorities, how we can implement, how we can read. So it's a mix of being practical. And also, one important point that CFOs or financial managers, they are not linking their operation with tax. So sometimes from his daily operation, he can benefit from any incentive, but he's not able to link or to clip the operational daily operation with the tax rule for tax relief.
Okay, so we are now approaching the end of this episode, and here are three rapid fire questions for you, Hani. Are you ready for it? Yeah? Okay. Here goes the first one. What is the biggest tax risks CFOs are ignoring right now?
I can say transfer pricing. So it's a number one area tax authority will audit next. This is my expectation. Again, personal expectation, especially management fees, intercompany services, pricing of related party transaction. This is very crucial and very technical point. So I think one of the biggest risks they are ignoring now is transfer price. Maybe they are underestimating, but believe me, when they are facing a tax audit from the local tax authority, for example, newly FTA, or that thanks only or whatever country, they will see a very difficult side of this.
Right. Okay. The second one. One tax myth you want to kill.
Free zone. Free zone equal tax free. This I want to kill. So it's not true. It's not true. Compliance, substance, qualifying activity, test, TV documentation, etc. All must be met. Many companies, many companies won't qualify for exemption, but they have this concept. Reason I am exempt. No, it's not.
Okay. And here goes the last one. One piece of advice for CFOs in 2026.
Small advice, because once digital enforcement start, fixing issues after the audit begins is too late. Create your structure.
Okay, Hani.
So invest
So,
in system documentation algorithms.
yeah. Yeah. Okay, this has been incredibly valuable, Hani. Like it was fun and it was so much knowledgeable. So thank you. Thank you for joining us and for breaking down such a complex topic in a way that's actionable for most of the CFOs. And that's a wrap on today's episode. For our listeners, Hani will be speaking at the CFOs and Finance Leaders Summit UAE 2026 on January 27th in Dubai, where he will be talking more about tax transformation. To explore more such topics in finance, stay tuned and join us at the summit in January. Thank you.
Thank you, thank you. See you at conference. Bye.